What's up, guys? It's Rowan
and Terry
here from ArtofSmartTV with another episode of the HSC Economics Review. Now, in this episode, we're going to be diving in to look at the federal government's macroeconomic response to the COVID-19 crisis. So we're going to be looking at both their fiscal and monetary response. Now, it's important to note that this is actually part 3 of a 3-part series. So the first part looked at the impact of COVID-19 on the global economy. And then part 2 looked at the impact of COVID on the Australian economy. So if you don't actually, have a good sense of the economic impact in terms of unemployment, and economic growth and inflation, we recommend that you go and watch at least part 2, because in this episode, we're not going to be diving in as much on the economic impact across the economic issues. Instead, we're going to be looking at very specifically the policy response that the government has made to try to respond to the emerging impact on the economy that COVID has had. So, with that in mind, we're going to be looking at macroeconomically, the overall response, but then in particular, we're going to be diving into both fiscal first and then monetary second, because ultimately, while you may get a question in your HSC Economics that asks you to look at macroeconomic policy, you may also get one that is more specific in asking either fiscal or monetary. So to kick us off, Terry, what has been the overall macroeconomic government response to the coronavirus?
Well, I think just to kick it off, it's been very, very expansionary. I think we need to understand just the sheer scale of this particular pandemic. It's been so huge, and therefore it's had such an impact on basically everybody across Australia. So there's obviously had to be very widespread policies brought in, basically to give the economy a bit of a kick. And so just right off the bat, I just want to say, if we start with the federal government, they've spent over 259 billion. Now these are numbers which are constantly just going to be updated, changing. Obviously, if you remember, there was a JobKeeper mistake that was revealed, I think in, I can't remember now, April, I think, or so.
Yeah, that's right.
So these
numbers, was a $60 billion mistake. Let's just also be clear on the side.
Yes.
So if we break it down, we've got as part of this $260 billion amount, right, that Terry's highlighted, which is a significant amount, and even more significant given we're talking about, well, one, the GFC, but also a Liberal government that's been pretty reluctant to spend. Now, I think we can see it actually through 3 distinct phases. There was a phase 1 where the government initially announced a $17.6 billion spending initiative. They then had a phase 2, which was a $66 billion initiative, which included, as part of that $66 billion, a fair bit of sort of what's called balance sheet support as well as active spending. And then they had a third and final sort of phase, which was the JobKeeper, which was $130 billion to start with, and then it's shrunk back to the $70 billion. Now, that's sort of what we look at if we think about fiscal, okay, in terms of the fiscal response. There's been about another $3.5 billion in total health spending as well. So if we sum up the fiscal response, we're sort of looking at maybe about $133, $134 billion, give or take, as fiscal response. It was originally meant to be 200, right? Remember that $60 billion mistake for JobKeeper. Now that's separate to a monetary policy response, right? So from a monetary policy perspective, there's been about another $105 billion that's been put into the economy. And that $105 billion has come through sort of 2 key things. It's come from, number 1, the RBA providing banks, with a $90 billion sort of set of funding to support essentially loans to business and lending to business. And then additionally some money, $15 billion in markets for smaller lenders. So we're going to dive into the monetary policy in more detail a little bit later, but you can see that the total size package is quite significant. Now, I guess the question, Terry, how does this compare to the rest of the world? I mean, we're a relatively small country. We've been relatively unaffected by corona. We've had a better success record, short of some recent Victorian flare-ups. How does this compare to other countries globally in terms of our macroeconomic response?
I mean, just starting from a study that was done quite near the beginning of the outbreak of the pandemic, we actually were ranked as the 2nd largest in the world. So again, want to touch on what Rowan was saying. You know, we were chasing that surplus for so many years, that fiscal consolidation. It really is quite surprising. But I think it's a welcome surprise to see that we have been, you know, really expansionary. We've been really going for it. And so, yeah, we've spent, like we said, Rowan said, about 130 billion so far. Probably more to come, honestly, as he was saying about, you know, how Victoria's having potentially a second wave. Maybe that might be transposed onto New South Wales as well. So there has been, I guess, whispers of, you know, extending JobKeeper, because one of the key concerns with JobKeeper was that it was going to, I guess, end after September, and then there would be this idea of a fiscal cliff, that, you know, all the spending is just going to ride into September and just literally fall off a cliff, and then leave a lot of our households in a pretty precarious situation.
And so if we put that in context as well, I think what's interesting is that, you know, more recent data still places Australia very high in terms of the size of the expenditure relative to the globe. Now, of course, not in terms of dollar amounts. You know, when you've got much larger countries spending, you know, trillions of dollars, the amount that we've spent might pale into comparison. But if we look at it as a percentage of pre-crisis GDP, you know, what becomes really interesting is that accounting for the reduction in JobKeeper, you know, Australia's measures are roughly 9.5% of our GDP. Now, the US currently is at the top, right, 9.9%, and that probably makes sense given they're also the country that have the most cases of coronavirus and have probably been the most significantly impacted as a result. You know, Japan is at 6.7%, and then New Zealand, the UK, and Canada are all about 4.5%. So when you put that in context, Australia's actually spent a lot of money, particularly because, you know, you think, you know, UK, you know, Italy, France, they're all spent much less, you know, 2.5 to 3.5% of their GDP, but they've also had a significant bigger impact in terms of COVID. So Australia, I think, has done a good job on that front, and perhaps has learnt from GFC and the success that the Labor government had during the GFC. It's interesting to note, actually, some of the economic advisors that advised the Labor government during GFC are the same ones that have been advising the Liberal government. And while the Libs would hate to admit it, it seems like they've learnt that lesson, right? Spend big, spend early, and it, you know, significantly shortens the length of any sort of recession and hangover that might occur. Now, thinking about this, Terry, I guess a question, right, is before we dive in and look at the specific packages and the phases of fiscal, right, because there have been 3 phases and probably a 4th to come very soon with an updated JobKeeper. What's the current context? What are we expecting the economy to do, and therefore what is the policy trying to fix?
Well, I think, yeah, you touched on that, Rowan. The idea would be to prevent the recession from getting worse. And the assumption obviously here is that we are going to have a recession. And so year-on-year growth at the moment is 1.4%, which doesn't look too bad. But if you looked at the previous quarter for economic growth, just for that particular quarter, it was already at negative 0.3%. So we were already contracting in the March quarter. You know, economists basically are saying the June quarter is a write-off. We're definitely going to be contracting there. So therefore, we're going to have our 2 successive periods of negative growth, meaning we are going to be in a recession. But I think, obviously, on the unemployment side of things, that's kind of taken off from about 5.2 early in the year to now at 7.1%. I think the whole point, though, is it's about minimizing the harm. There's definitely going to be harm, and I think many people will tell you, like, I'm obviously quite young, I have plenty of friends who are affected by this, by the way. Young people affected more so than other age groups in terms of their employment. They're going to feel the pain, but I guess the objective here is just to limit that pain.
And I think it's interesting because if we get some context, you know, it's expected really that over the first half of the year, so those 2 quarters that we're saying, you know, negative growth, the March and the June quarter, it's expected that there'll be a contraction, a record contraction of GDP of 10%. So while the first quarter maybe not so much, there really is, as Terry said, expecting the June quarter to be just a massive write-off. But the hope then is that with the policy initiatives that we're about to unpack, the hope is that that can, you know, we see the September quarter bounces back, probably still negative growth. I think that would be very unlikely that it wasn't. And then hopefully as we start nearing, the beginning of 2021, we start seeing that turnaround. But this all depends on really two things, right? It depends on one, the extent to which the labour market and the economy still get impacted by ongoing social distancing measures and closures, which unfortunately the Victorian flare-up has probably put the economic recovery a little further back.
Yeah, and I think they also mentioned that particular lockdown is going to cost Victoria about $6 billion. So just to give you an idea.
Yeah, it's about, I think because it's a 6-week lockdown, I think they were saying it's about $1 billion a week in cost. So that's sort of the context we need to be mindful of then when we think about, okay, the policy the government has implemented, and therefore will it have the desired effect in actually bringing us back, with that V-shaped recovery, right? Or even what effect will it have in even enabling a U-shaped recovery? I mean, that's something that needs to be considered as we sort of unpack.
Did we mention a W-shape?
I think we did also mention the W as well, right? It sounds like it's Sesame Street and we're doing our ABCs right now, doesn't it? What's the W for the sake of the guys watching that haven't heard of a W recovery? What does a W look like?
Basically, just a sharp decline followed by what you call in trading a false breakout. It looks like the economy might be getting back on its feet, recovering, only to decline back again.
And I think that's also been very much contingent, and I think it might not even necessarily be a W. It might be, sort of a couple of W's strung together, because to some extent it also depends, as we've highlighted, and this is the real challenge about whether or not there's second, third, fourth wave breakouts, right? Yeah. And to the extent to which that you start seeing little mini recoveries and then reductions because of shutdowns, and so. Something to be considered. So let's dive in, Terry. Phase number 1, that happened very early on in the journey. It was, March. It was a very quick response that the government made. What were some of the key things that phase 1 of the stimulus package, which was a $17.6 billion stimulus package, what were they sort of designed to do?
Well, I think all of these packages in general, they are really targeting expenditure. So just to bring in some theory real quick, if you remember in topic 3, you would have looked at economic growth, basically, in the short run, is going to be determined by something called aggregate demand. And aggregate demand is made up of consumption, investment, government spending, and the trade balance. And so if you can clearly basically see that this initial stimulus package really did try to target those specific categories. So starting off with, for example, business investment. They've had an increase to that instant asset write-off, which they were already kind of trotting out, in last year's election. They'll increase that threshold from 30,000 to 150,000, basically really encouraging, businesses to get out there and invest more into machinery and capital, because it was already something which was quite weak beforehand, and so they were really hoping for it to encourage businesses to get out and use this as an opportunity to invest more.
And so it was expected as well to reach over 3.5 million businesses that were employing more than 9.7 million employees. So it was expected that it would touch, 3 in every 4 workers. Now, I think the thing that's interesting is that, to encourage business investment, it sort of, implies that the businesses have the cash to make the investment. And so I think very quickly, as we'll start to see with particularly the next phase 2, there was a realization, well, actually, wow, the businesses don't have the cash, and we see a lot more initiatives looking at trying to prop up business cash flow. So that's one of the limitations of this. It's a great way to encourage businesses to invest and thereby, increase aggregate demand in the economy, and it requires, though, businesses to have cash.
Yeah.
So then there were some other things that they did here. I think one of the other big things was definitely around consumption. So you can see them really looking at the drivers of aggregate demand in an economy, and they're trying to go, well, what levers can we pull on these so that we can get them kicking?
And you've got to remember also that consumption makes up about 60% of that demand.
That's right. So what they had was a $4.8 billion one-off stimulus, right? It was $750. It went to pensioners, social security holders, veterans, and other income sort of support recipients. And it was really about just giving them cash so they could go out and spend it, right?
Which really sounds quite familiar to what they did during the GFC.
That's right. Okay, they did the exact same thing. It was a $900 amount during the GFC, a little bit less this time. And I think the goal here is very much to just try to rapidly stimulate consumption in the economy with just a cash injection, which then would have a multiplier effect, right? Which would then cause businesses to see, increase in income and sales and having a flow on. Now, half of the people that were expected to get this were pensioners. And I think that was maybe one of the criticisms, right, that came through with this initial $750 stimulus payment. I think the intent was to look at who are people in the economy that already have fairly low incomes, and how do we give them extra sort of funds in case there's any worsening of distribution of income and we get them to spend. But on the flip side, as lockdown occurred, I know a lot of pensioners that were like, I don't know how to spend this money because I'm not comfortable with internet banking and I can't go to the shop. So it became a little bit of this funny, sort of outcome where I think a lot of pensioners just sat on the money, ironically, rather than actually spending it. So what are the limitations? Now, there was some stuff they tried to do with unemployment as well, Terry.
So this was obviously before JobKeeper came in. So they had $6.7 billion just to basically boost cash flow for employers who were up to $25,000 with a minimum payment for $2,000 for eligible small and medium-sized businesses. So basically, I think we discussed this earlier with the investment. Businesses really were struggling in terms of cash flow, which would be obvious. Even before the lockdowns happened, I think I did see a lot of decline in business activity. Like there really wasn't.
Well, because people were preemptively starting to be a little more concerned about social interaction.
They were going to supermarkets, but you think about other small businesses, like bakeries, hairdressers. They were feeling squeezed.
Now, the other big thing they did here was they had $1.3 billion to support small businesses, particularly around apprentices and trainees. And that was really important. And this is particularly if we link it again to a little bit of theory. If we think about just structural unemployment and skill shortages in the economy, one of the big concerns that they were having is, well, if we see a whole lot of trainees that are needing to work as part of their studies, and businesses can't support them and they let go of them, all of a sudden, fast forward 5 years, 10 years, you've got industries that have really big skill shortages that they can't fill. And then we've got a pathway of, well, how do we retrain other people at that point to come in? Or how do we even import through skilled immigration? And it creates a lot of challenges. So you can see how there was some strategy in going, how do we actually prevent this from occurring and retain the ongoing sort of training of these, apprentices.
And I also want to touch on that. Something which was kind of missing. I think that's a good point that you bring up. Like something that was missing. Obviously, they're trying to propose changes to the structure of university fees, and I think that also kind of touches on that point about structural unemployment. Obviously, I understand. Those of you who are watching, you are obviously doing the HSC, and you guys are probably rightfully so worried. Especially if you are watching an economics video, you might be thinking of studying economics, which is, to my knowledge, doubling or even tripling in price.
That's right, yeah. Well, it's part of commerce, right? Yeah. More broadly, yeah.
So, but I think it's a good point though. Like, if those particular courses are oversaturated and they do have quite a lot of people in it, there could be I guess there is at least a structural unemployment argument here to say that we don't necessarily need people in those professions. Let's think about other.
That's right, and so it's sort of a dual approach, isn't it? It's like, let's get people into the right areas and let's prevent losing people in the areas we know we need, right? So I think overall, there were some other things in this initial phase one. There was some money, $2.4 billion as a health package, just designed to support, vulnerable groups, particularly the elderly and Indigenous. There was some funding to support the shift to just online health, so online prescriptions and telehealth, which was really important. And there was $1 billion spent to support specific sectors, so tourism, agriculture, and education that had been massively impacted very quickly by the coronavirus. So, and you can see that's slightly more microeconomic, because while the budget's often considered macro, and it often will have within it initiatives that are supply side. They're aggregate supply and they're quite industry targeted. And I think that's something that as we go into the later stages of these phases, I know Terry has some stuff to share around just specific industries and how the government's had to dive in and actually support specific industries, particularly supply. And so it's slightly more micro-focused in terms of some of the policy. So let's move on. We've now got the big $66 billion stimulus package. And I think this one came as both a surprise and not a surprise. Not a surprise because there clearly needed to be more funding with the impact of shutdowns. But then on the flip side, quite a surprise because, all of a sudden a Liberal government's just, splashing cash. It's like, what's going on here? So it was a surprise on that front. I think there was a real key component of this that got the most attention? What was sort of the biggest focus or the biggest component of this $66 billion phase 2 package?
So I would say that would just be, you know, they were beefing up those payments. Right, so they were giving special payments of $550 per fortnight over the next 6 months. So we've already touched on, you know, that September cliff, right? But they were basically just increasing the Social Security for basically a whole range of different programs that they had. So they had the Job Seeker. That used to be called New Start. They've renamed that to Job Seeker. Basically, those who are over the age of 22 and unemployed. They had the Youth Allowance. So those are, I believe, those who are studying. Yeah, so students. I think there was also a bit of I remember seeing some stuff, you know, because I have a lot of friends who are still studying who were, I think initially they didn't want to include students into this package, but they did end up getting included. They had this for parents, they had it for farm households, and they had also just some other special benefits.
So it's important to note here that one, you know, there's already these payments were in place, right? It's not that they've introduced a sort of a new category here, and they have in phase 3, but here they've just topped it up, and by quite a significant amount.
Because normally they are only, I think Job Seeker itself is only about 550 or so, like roughly around. So it was roughly like doubling.
Yeah, it was quite a significant top up, and it's sort of a dual approach because remember, you know, automatic stabilizers, just to link in a bit of theory, as we go into an economic downturn, you have more people that are seeking these sorts of welfare and unemployment benefits. And so not only were they topping the amount up that they were going to provide people with, there was also an expectation that more people would be accessing these support than ever before. Now, I think what's interesting here is that you know, they also then decided to add an additional $750. It was meant to be a one-off in phase 1, and they decided to add another to it, another $750 payment. And that was, again, to essentially the same sort of target groups. And that was expected to reach approximately 5 million people. So it was a further cash injection, essentially, going, okay, great, we're going to do cash injection through topping up, you know, Job Seeker and you know, a youth allowance and so forth. But we're going to also put this extra cash in, and hopefully that'll give almost, you know, the way I view it is almost like, you know, in those movies where someone's about to die and they get the paddles on them and they're like, you know, like trying to just resuscitate. It was like, let's put in a huge amount of cash to then get the multiplier kicking to see if we can grow it. Now, maybe that's a little morbid as an analogy. Maybe not. You can judge. Now, I think a question, there was something a little controversial that they did here as well, Terry, and that was what they did with superannuation.
Yeah.
What did they do?
They let people who met specific criteria withdraw their superannuation early. And to my knowledge, I don't think we've ever let people do this. And for good reason, because your superannuation is supposed to be a retirement fund. It's invested for you so that you have, you know, access to funds when you retire. So it was quite controversial. The actual amount was, I believe, $10,000 for the next 2 financial years. So totaling, you could potentially withdraw up to $20,000. And so, yeah, so just to go through the criteria, you had to be unemployed. I actually checked this the other day because I wanted to see if I could, but I couldn't.
Yeah,
just to make sure,
just,
you know.
for fun.
No, I was doing my taxes, you know, and I saw that, you know, oh, it's a pretty big year, so I might want to take some more money out because I had to repay my HECS debt. So that
painful.
Really, yeah, so I was like, you know, I wouldn't mind having my 10,000 super right now, but yeah, you had to be unemployed. You had to already be on, you know, some of those Social Security that we're talking about, you know, Job Seeker, Youth Allowance, parenting, and farm households, and you also had to have, I guess, evidence that you were experiencing financial hardship.
So I think the point of it was almost to say, well, look, we're gonna provide this top up of $550 to these existing payments, and you might now be on this payment, but what if that's still not enough? What if, you know, just because you had been working and you had a mortgage and all these other things going on, that was falling short? And so it was designed really to be a bit of a bridge between financial difficulty and then the economy potentially recovering or other options being made available. Now, I think the real concern about it, though, is that, you know, the power of super is compounding over the long term. And so the real concern is that the markets had taken a tumble and they've recovered to some extent, but certainly they're not yet back and probably won't for some time necessarily get back to where they were. And so for a lot of people, that super that they had is invested in the market, just through industry funds or managed funds.
Yeah, I got an email telling me that they'd been losing money this year.
Yeah. So the concern is you have a lot of people that their funds are down and then they're taking money out. And so that's going to have a significant compound effect, not now, but over the long term, which will then ultimately actually cost the government more later through increased pension support, right? In terms of more people needing to draw a larger amount of money in terms of the percentage of their income from a pension as opposed to their superannuation when they retire. So I think that was the real concern. The real concern as well is that the people that might use their super would also be those that were already less well off, and on the lower end of the socioeconomic sort of spectrum, and therefore their super already would be quite low, which would exacerbate potential concerns around distribution of income and wealth. So if you are needing to analyse that, that's one of the areas that you could bring in, which is concerns about long-term impact on distribution of income and wealth.
But I want to just add something onto that. But what's interesting is as we are talking about distribution of income and wealth, the fact that they've already added, 550 to this Social Security, and then they're saying that's still not enough. What does that show you about the normal, I guess, payments, when we're not going through COVID? I just want to make that point there.
Yeah, and I think the tension here, and this is bringing in a little bit of theory, and this is something that you can use to analyse the policy as well, is that it does certainly, and that's one of the big criticisms that has occurred, is that the government has intended to roll back the 550, additional top up at the end of the 6 months, and people have said, well, actually, really should you, because the initial amount seems so low. It seems like perhaps this is actually, where it should be. I think the government's concern is ultimately when we look at the economic benefits of inequality, there actually are, unfortunately, some economic benefits. And one of those benefits is the incentive effect. And that incentive effect is the incentive to do further education and training, the incentive to be more occupationally and geographically mobile. And so I think it's just about trying to find the right balance. And I think the question is whether or not the balance is right now.
I don't think so, because they're making it more expensive to go to university. So
okay.
I don't know about that one, Rowan.
So, just before we move on to phase 3, JobKeeper, which is the sort of big thing we need to unpack, there was two other sort of key areas in this phase 2 $66 billion package. There was a boosting business cash flow, which, as we talked about, right, was an issue. If businesses don't have cash flow, they can't invest. And this was designed to provide businesses of up to $100,000 of cash flow support. A minimum of 20,000, I think, was sort of what would be expected for businesses, but it could be up to 100 depending on the number of people that business employed. So it was sort of rewarding businesses that were continuing to employ people, but also support their cash flow to continue to employ those people without letting them go. And that was also extended for not-for-profit organisations, because there was a lot of concern, that right now a lot of not-for-profits and typically actually provide a lot of really key support in the economy for people that are disadvantaged or struggling, where the government has actually stepped out because the not-for-profits are there and might also be actually accessing government funding. So it was quite important, and they eventually did that, which was great. Now, there was a small amount of money also allocated to further health. Any sort of key initiatives that came through from that, Terry?
Basically, just I think for their aged care services.
Yeah,
right? I think unfortunately a lot of the initial cases were in aged care. So I think the government saw that they did need to ensure that aged care was getting the funding that it needed, just to make sure that they were able to keep
people alive. Honestly, I think the big issue is that yes, like elderly were struggling, they couldn't go out, they still technically can't. All of a sudden, you need more support services, more delivery. There's all sorts of infrastructure that needs to be put in place for that. So now let's move to phase 3. Phase 3 is at this stage the final stage, and it was the largest actually out of the 3. Although as we expect, there will be a phase 4. Which will be a phase 4 that actually articulates what happens post-September. It's been argued that the government has not yet revealed that because of just, there was a recent, by-election in, New South Wales in terms of Eden Monaro, and there was a hope that they'd potentially wait to see the outcome of that before they revealed any phase 4. So we really expect almost any day, I think.
I think 23rd of July, that's what I saw. I don't know. Yeah. Don't quote me on that.
Which is, almost any day we could expect we see phase 4. But phase 3, what was phase 3?
I think, just the JobKeeper, right? The JobKeeper phase. I think...
It's a great way to remember that, I think. I'd almost remember phase 2 was like the job seeker phase, right? Because ultimately the crux and the core of that was focused on that. And then phase 3 was JobKeeper. So what was it? What did it involve? How did it work?
Oh, okay. So initially, right, it was announced as a $130 billion basically wage subsidy. So this was around the time that businesses were having to stand down their employees.
And that was forcibly because, the government had made mandatory shutdowns. It was cinemas closed, cafes closed. So, firms didn't have an option.
Yeah.
How do you keep on paying staff when you're no longer able to earn revenue?
Yeah, so rather than letting them go, the government came up with this idea basically to give them give the businesses a $1,500 per fortnight wage subsidy so that they could use that money to then pay the employees while they were being
And so what was the intent of that? Because I think it's quite an unusual sort of policy step to take. What were they hoping to do by providing this to businesses?
Well, I think the goal here basically was to keep workers in those jobs, right? I think, of course, if we're going to talk about the fact that there was a by-election and there is, looming elections coming ahead, I know that the Liberal Party has had their approval ratings improve because of how they've handled the crisis. I think it is very important that, that people are kept in those jobs, obviously for political reasons, but also simply because it's, if people are let go of their jobs, it could make the recovery take longer.
That's right, and there's a couple of really good reasons for that. So I think one, me being a little cynical, and we're going to talk about this in a moment, if people stay in a job through JobKeeper, they're no longer considered unemployed.
Yeah.
So our unemployment figures start looking a lot better. But I think putting the sort of cynical economic outcome aside, I think underlying that is the real concern the government has in any recession is that there is always a hangover of people that become long-term unemployed, and then as a result of becoming long-term unemployed through hysteresis also become structurally unemployed because they see skill erosion. And there ends up becoming over the long term a mismatch of skills and available work, and that's actually really, really costly to a government to try to get rid of. It takes almost a decade post-recession to actually try to work through the structural and long-term unemployment that's actually occurred as a result of that recession. So I can see the government's thinking here is to go, hey, how do we retain those employment connections so that people stay in employment marginally, even if they're just getting paid to be stood down, so that the hope is that as businesses can start reopening, they're immediately going back and we're not seeing this big sort of group of long-term unemployed emerge. Now, how many people was it expected to reach in its initial phase?
So 6 million was the figure that was quoted. In actual fact, it was closer to 3.5 million. I think one of the reasons they gave was that the form was actually quite confusing to fill out, and that businesses were putting 1,500 employees, and they misinterpret that as how much money they were seeking from the government for JobKeeper. So they basically,
And then when they did that maths, and it actually worked out quite funny because both the government and Treasury made different mistakes, but got to the same outcome of about 6 million workers. So that's why initially, no one really picked it up, right? Because the fact checking revealed something similar. So the point though is still 3.5 million, which is still a significant amount. If you think about 3.5 million people, essentially, their employment is being supported and propped up, right, by the federal government. Now, it was also applied to not-for-profits. There was initially some sort of questions about would it not, but it was, which was really great. Now, I think if we sort of look at it though, there was some eligibility requirements that needed to be met, right, to be able to receive JobKeeper. What were some of those eligibility requirements?
So the first thing was that they actually had to be registered with the organisation by the 1st of March 2020. So that obviously put some people who'd recently just found a job into a bit of a difficult situation where they weren't eligible. The other thing is that casuals were those that had to have been with the business for over 12 months, which got a little bit of a debate going about the idea of a long-term casual, which is an oxymoron because if you're a casual, you shouldn't. How can you be a long-term casual? So there were obviously discussions about the nature of our labour market there as well.
That's right, which is interesting if we go back to the labour market reforms and labour market policies when we start looking at that, the sort of decentralisation, deregulation shifts, but also casualisation itself. I think what was interesting here is that there was another group as well. You needed to be an Australian citizen, okay, or at least you needed to be the holder of a permanent visa. So there were a whole lot of people that were excluded from that were like international students, for example, as well as people that might have been here on, a visa that didn't quite meet some of the categories that they had. So this created a lot of discussion. A lot of discussion because I guess number one, for those that were casual, they tended to be, largely, younger people in roles. And so there were a significant amount of, young people that didn't necessarily, didn't qualify, or the companies that they worked for didn't qualify for JobKeeper. But additionally, also certain industries, entertainment, hospitality being two really big ones, are typically those that do have often a high level of employee staff turnover just due to the nature.
Yeah.
And so it meant that actually some of the biggest hit industries
didn't get it.
Yeah, the employees within they didn't get it just in part due to the nature of the industry itself, outside of any questions about sort of labour market, policy. Now, what was the impact? I think we've now seen it. It's obviously been in place for some time now, really since May. What's been the impact of JobKeeper so far?
Well, I think it's actually, had a pretty big impact. I think it's safe to say it's clearly the largest of the 3 stimulus packages. So we've got 3 in 5 businesses reported have actually registering for the JobKeeper payment. At the recalculated $70 billion cost, it would be around 6 to 7% of the GDP. And so, I would say to start things off, it has been, one of the, I'd say the largest really, single piece of fiscal stimulus Australia has had. And it has obviously impacted quite a lot of people.
That's right. So, as we've highlighted, it's probably impacted different people in different ways, and that's some of the questions. One, as we've said, casual employees have been largely excluded from being able to access it, and also those in certain industries. There's also been a sense that the system has actually sort of perhaps incentivized firms to keep a couple of part-timers on and let go of a lot of others, right? And put them on. So it's still creating a connection with some employees, but in some respects, it's made decisions for employers in who they keep on. A big concern, the Victorian Trades Hall Migrant Workers Centre identified there was about over 1 million temporary migrant workers that were left in the cold. And if we think about it, they've got no way to get home. International flights are largely down, all very expensive, and they might not be able to afford it. But equally, they've got no way of being able to earn an income necessarily here as well. And so there were some really big concerns. Now, I think overall, the analysis from Deloitte and Westpac and ABC, even the RBA, indicate that this has been very successful. Westpac did some analysis and they said, the initial peak unemployment that was forecast, right, for June was 17%. Right? That was the sort of peak. And what they're saying now is that both, Westpac, the ABC and the RBA are all saying, well, look, we'd sort of expect that, we would expect unemployment maybe to peak at 9, maybe 10% on the max now in the June quarter. And then the hope is, depending again on the extent of recovery and relaxation of restrictions, we'd start to see that unemployment again slowly fall. So I think that's been a really sort of positive thing in terms of its impact, right? Really almost taking 10% off on the max, or at least halving like potential unemployment in the market, which I think is quite fantastic. It hasn't all been good news though, right? What has been one of the added consequences that has happened as a result of this?
Well, something that I guess we haven't really talked about too much because, at this stage, it's really just the focus of recovery and making sure that we can continue ticking on. It's been this idea of the budget deficit. So obviously, if we're going to have historically large fiscal stimulus, we're also going to have historically large budget deficits because just if you remember, your government spending is going to directly lead to a bigger deficit based on that T minus G formula that you guys are learning about. And so for this year, obviously this was supposed to be the year where we were back in black with the budget surplus. Obviously that is not happening. We're actually looking at a biggest budget deficit of all time, $100 billion, 5% of GDP, and then it's going to get even worse in 2021. Yeah.
That's right. So it's just building, and that's partly because if we think about it, for this budget deficit, ultimately there was only a couple of months in the financial year, and so most of it will be in the 2020 2021 and beyond, right? It's confusing to say, isn't it? Now, I think what's also interesting about this is, of course, that's going to lead to, over the long term, some external stability concerns. You know, it's going to lead to some crowding out, you know, ongoing crowding out, you know, and just to link in a little bit more theory, you know, there's an idea of the twin deficits theory. You know, the larger, you know, we have the budget deficit, often the larger the CAD becomes. Now, right now, we've got a surplus on our, you know, balance of goods and services, and as a result on our current account. That's quite historically unusual, but it certainly does present some challenges for the long term. Now, the other big thing here, I think, just to note, is that the concern ultimately is that this is going to create a lot of underutilization. So maybe while we're seeing our unemployment rate not jump up too much, what that's not really doing is it's not really giving us a good sense of the true state of the labour market. So if we look at some of the sort of May data from the ABS, what did the May data reveal?
So basically, underutilization, right? If we look at this, it's really taken off. I think underemployment used to hover around that 7 to 8% range. It's really taken off to 13.5%. And if you remember, underemployed workers are those who are currently working but would obviously want more hours. Okay, so we are going to see, I guess, increasingly probably even more. So it was already an issue before JobKeeper with people missing out on certain things, being part-time and casual. We're seeing possibly even more part-time, even more casual workers. The other thing that sticks out to me is just the participation rate. Yeah. So we were actually trending really, really well in participation. So we've been steadily rising. We hit about 66% at its peak. It's fallen all the way back down to 62.9%. So issues there simply because if people don't want to participate in the labour force, it shows that, you know, they as Ron was talking earlier, that they might lose their skills. And they might become long-term unemployed.
And so I think what we're seeing is actually, you know, the unemployment rate 7.1, but what it's hiding is, I think, two things. One, it's hiding that a lot of people are not working as much as they would like, okay, which, you know, we see it right, our underutilization rate, which is unemployment plus underemployment, just hit a record high of 20.2% in May. Right, which is 1 in 5 people right now are either unemployed or underemployed. Now, it's important to note the second issue that it doesn't really capture is that, remember, to be considered unemployed or even underutilized, you need to be either having a job or looking for work. And what a lot of people are doing right now is they're looking at the economy and going, well, I'm not going to get work, right? Like, one, because all of the industries I work in are still shut down. So I'm just going to stop looking. And so we've seen, right, as a result, that's why that participation rate is falling. Because people are actually just not looking for work. And so it's interesting, what they've identified is that 2.3 million people, 1 in every 5 employed, have either lost their job or had fewer hours of work. But underneath that, what they were actually saying was that there was almost a total loss of 835,000 jobs since March. And so what we're seeing is that there is a lot of people that have just stopped looking for work, and our unemployment rate probably truly would be a lot higher if we had still counted them in the actual official statistics. Now, we haven't, of course, but the ABS has done that for us. They have created what they call an effective rate of unemployment. Okay, if we add in people that have left the labour force, right, and we add them back in, they say that actually the effective rate of unemployment would be closer to 11.3 right now. So you can see that the 7.1 is probably really hiding quite a lot. Yeah. Now, so overall, I think we can say that JobKeeper, you know, look, it's a complex challenge. The big sort of concern with the analysis here is what will happen in September. When the funding runs out, a lot of businesses still won't be able to necessarily pay, and so it's why we need to really see what phase 4 might look like. Now, post phase 3, there have been some other policy announcements the government has made that I just wanted to touch upon. Yeah. And these have been, in many respects, very targeted at very specific industries. What are some of these things that the government has been focusing on?
Well, just to start, I guess, chronologically, I think the next one was something called Home Builder, which was they were noticing that there was a significant slowdown in basically the housing sector. And so they understood that, again, it's really about providing funding. So if you can provide some extra funding, or you can give some incentives for people to either build a new home or to renovate, then that might specifically, you know, be the stimulus that really helps the building sector.
That's right. And so I think there were obviously some limitations on it in terms of, you needed to be meeting like an income cap to be able to qualify. And then it also was critically, a very time constrained when, again, it was just over a 6-month period that they were allocating for this. Now, that was one area, and clearly that was very strategic in wanting to really get the construction industry kicking. So it was almost, very, very targeted, which some of the other stuff has been much more macro. There were some other things they did. What are some other things they did, Terry?
So the other thing that stood out to me was the job maker. Right? So they've gone job seeker, job keeper.
They've got a great marketing team, don't they?
Scotty from marketing. Yeah, but this one here is I think we met. Sorry, I'm losing my voice. Earlier we mentioned that the entertainment, the arts, and the tourism industry really did suffer significantly. Some figures here show that it's about a 600,000 worker industry with about $112 billion of spending each year. And so they've come up with just a targeted package of $250 million basically over the next 12 months to help restart the creative economy and make sure that there are these projects and opportunities have the funding that they need, because obviously they haven't been able to perform. And so we've got a couple of things here. We've got show starter loans. We've got supporting sustainability of sector significant organizations, just basically money just given to help these people get back on their feet.
Awesome. Now, the final thing we want to look at in this video is that's all the fiscal response, right? We also need to consider the role that monetary policy has been playing as part of a macroeconomic response. And so, monetary policy has really had a 4-pronged sort of approach in terms of what they have been seeking to do to support the economy. And that all really came from, again, quite early in March, right? 19th of March, the RBA came out very clearly, and a lot of that was actually about providing confidence to the economy as well. It was very much a forward guidance. Like, hey, here's what we're going to do, and this is why you should feel comfortable and confident in the banking sector, and you should feel confident and comfortable in, knowing what, to expect for, your home loans, even in terms of the cash rate and interest rate. So what was the first prong of the RBA's response?
So I think we've already touched on this as well, that the RBA was extending at least $90 billion in funding just basically to support banks, to then support businesses to ensure that they had sufficient cash flow. They were doing this also at a very low interest rate of 0.25%. So basically to reduce those borrowing costs, to keep the interest low on that, and to basically make sure that small business enterprises had enough to keep going.
That's right, exactly. So that was the first component. Now, the second component was just actually easing of the monetary policy itself and the cash rate.
And that was at an emergency meeting as well in the middle of March.
That's right, exactly. It came as a bit of a surprise, but they cut the cash rate there to 0.25%, and it's really stayed there over the last sort of 5+ months, right?
Yeah, they did that 2 days ago as well. Yeah,
that's right. They just announced they're holding, and that's partly because there's not really a whole lot more they can do from a cash rate perspective, at least. Which is why we then see step 3 being certainly the more unusual for Australia. It's something we talked about very early on in 2020, and we've got a prior video where we look at alternate forms of monetary policy in terms of we were predicting what the RBA might do, and one of the things we talked about was quantitative easing, right? And the likelihood that if the global economy didn't go the right direction and, the COVID crisis that was emerging would worsen, the RBA would be forced to go here. Now they have. What is quantitative easing? Just as a reminder for everyone, Terry, and what has the government been doing, or the RBA been doing on this front?
So basically quantitative easing is when the central bank they print money, in a sense. They print money, but they use that money to purchase secondary government bonds or other types of financial assets from the private sector. Basically, when they buy these assets, they're going to drive up the price of these assets. And when you drive up the price of an asset like a bond, for example, you lower what's called the yield. And when you can reduce the yield, that means that you're going to be able to keep not just the cash rate low, but also other types of market interest rates low as well.
Yeah. And so I think that's been one of the really big things that the RBA has had to realise, is that there's been issues with the transmission mechanism maybe not working as much as they would like. One, that happens when the cash rate gets so low to start with. But two, also, the consequence of that is the banks don't always pass that on, right, in terms of interest repayments. So this is where the government is, the RBA, I should say, certainly taking a much more aggressive step into the market. Now, it's important to note when we've got the central bank buying or purchasing government bonds, this is not an initial offering of government bonds. So it's not that they're essentially funding the deficit budget, right? It's not like they're printing money and that's what the government's spending with their money. This is secondary bond market, right? So this is where at some point in the past, the government has sold some bonds, right, to raise some capital, and then it's since been traded on the private market, and so the RBA is stepping into that market. Now, their goal is to maintain the sort of, at least the 3-year Australian government securities bond rate to 0.25%, which, surprise, surprise, is the same rate as the cash rate, which is where they're trying to essentially maintain this low interest rate environment, not just a low cash rate. Now, how much have they spent so far? Because they've been quite active, really, since March.
Yeah. So we've got about just over $51 billion in bond purchases. Of those, 78.4% of those are federal government notes. And so overall, if you have a look at the total Australian government bond market, they actually own close to 7% of it now.
Which is quite significant. Yeah. So you can see that they've made quite a big foray in, and it's likely that this will continue.
And it's good that they're transparent with it, right? Because it means that, whatever they're doing, they're letting us know, and therefore, it's, again, bringing that confidence and the forward guidance.
That's right. Now, of course, if we were to sort of evaluate the policy, I think we know that the cash rate itself has already been having a much smaller impact in terms of, changing economic conditions. QE does have a good global set of examples where it has been successful. The US is probably one of the more successful examples. Japan on the other side, less so. So it's unclear to what extent over the sort of medium to long term this will have a positive impact for Australia. I think in most cases the challenge is what happens is you start to wind it back. It's almost a little bit like again, I'm going to go with some interesting analogies today. It's almost a little bit like a heroin addiction for an economy. And it can be very difficult for economies to then, over the long term, get used to not having these injections of cash, which is just printed money. Terry's loving it today, I think. Now, what's the fourth and final prong?
So usually how the RBA implements their monetary policy, they have something called the corridor system. So basically, they'll set a cash rate target, and what they lend to the other banks in the overnight cash market will be 0.25% above, and what they will pay those banks depositing with the RBA in the overnight cash market will be 0.25 below. Now, there is obviously an issue with that, because if you do the maths, if the target is 0.25 and then their deposit rate that they're giving to the banks is 0.25 below that, you're going to hit zero. So what they've done instead is they've done it at 10 basis points. So it's only 50, so it's only 0.15% lower, that lower corridor.
Now, and I think the point of that one is ultimately it's the idea of a corridor, and this is a little bit of theory, but I think it's worth just highlighting because I feel like a lot of students tend to not really understand the corridor that well, is that ultimately, what the RBA is trying to do is it's trying to incentivize banks having the right amount of cash in, the exchange settlement accounts to maintain the 0.25 or whatever the cash rate is. So the banks can choose, and what happened during the GFC was that because the banks were concerned about the overall stability of the financial sector, they actually shoved a whole lot of money into their exchange settlements accounts, which meant it was quite difficult at the time for the RBA to necessarily maintain their target cash rate. So part of this is designed to, one, just mitigate the fact that, the banks will typically actually hold a little more in their exchange settlement accounts anyway, reduce some of the costs to the RBA for that, but also still provide some form of return and incentive for the banks to do so they can maintain their 0.25% cash rate. So it's, in effect, quite a good strategy. It's just a tight corridor now, and that's to be expected as the cash rate gets lower and lower. Yeah. Now, there has been a little bit of a broader banking sector response as well, outside of the RBA. What has that involved?
Yeah, and I think the RBA would have hoped that, right? You know, they're obviously, you know, as you can see, pulling out 4 prongs, they would have at least hoped that the private banking sector would have done something. And the main thing I've seen is that they have given opportunities for loan repayments to be deferred. So initially, I think it was for small businesses, it was up to 6 months. I think for mortgages, it was they had deferred payments there as well. And I think recently I also saw that they are hoping to actually extend that a little bit longer.
And yeah, I think that's, again, it comes to that exact point, that cliff, right? What happens when all of a sudden you've been able to, you know, defer and not have to worry about paying your mortgage, but you still don't have a job, and then JobKeeper runs out, and the deferral and your loan runs out, everything hits at once. And there was a real concern that that would create a perfect storm for, you know, people defaulting on loans and mortgages, and then the impact that might have on the property market in terms of prices as well. So, you know, again, it's not yet certain what the sort of ongoing banking sector response will be, but we can see how, I think what has been really great, and I think a real testament to coordination of policy, not just at a state level. We've seen that happen with, you know, the national cabinet that was created, but actually a real coordination between monetary, banking sector and fiscal, which wasn't happening pre-COVID. You know, like, you know, the governor was constantly at, you know, Josh Frydenberg to have more coordination, and that fiscal needed to do more work. And so it has been great to see that there has been that alignment.
Can I make an analogy now? It's like the Avengers, they assembled.
Yeah, and that's such a better analogy than any of the ones I've made, and so much more appropriate than any of the ones I've made on this episode. Fantastic, guys. So there you have it. That's a very comprehensive look at the policies, you know, the expected impacts, some of the concerns and, you know, issues and risks with that. And of course, some of the sort of statistics. Note, this was, if you missed the first part of this video for whatever reason, the third part of a 3-part series. So really, what we would recommend is, if you haven't already, jump back and look at part 1, impact of COVID on the global economy. You remember, topic 1 is all about ultimately the global economy and globalization. So that video is going to be super useful for you in getting some real up-to-date statistics and analysis understanding. Part 2 is the impact of COVID on the Australian economy, which, remember, is all really topic 2, right? Australia's place in the global economy. And then this third part today was really all about, you know, issues and particularly the policy response, right? Which is
topic 4.
Yeah, exactly. With a little bit of topic 3 thrown in, right? A little bit of the theory. So if you have any questions, leave it in the comments below. You know, we'd love to help you. If you're needing any more support for economics, you know, we have. So I know a guy that teaches a really great economics class, Terry.
Really? Who?
You.
Oh, really?
If you need any help, guys, more than what we've shared today, particularly prepping for your trials in HSC, which probably this year will be unfortunately a little more challenging for economics, although more interesting at the same time, get in touch with us. We've got an awesome team of tutors that can support you both one-to-one and in classes. And of course, if you haven't already, hit that subscribe button, because we do videos.
And like the video as well.
And like the video, and share it with all your friends, of course. But we try to do videos every single week. HSC Economics Review monthly. We'll see you next video.